How does a liquidity pool work in crypto, Uniswap, and Cake? Decentralized finance, or DeFi, has revolutionized the crypto industry. Before DeFi, investors heavily relied on centralized exchanges and banks for trading and booking profits. Now, there are many decentralized platforms for buying, selling, and parking crypto to generate passive income through yield farming. Hey guys, welcome back to Crypto Animations, the channel where we explain to our viewers about the different types of cryptocurrencies and everything new investors should know. In today's video, we will talk about what liquidity pools are, how they work, what they do, and more. So be sure to be attentive, because you clearly don't want to miss out on an amazing opportunity to win a giveaway of a $25 crypto coin of your choice. Also, if you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. Now, with the intro out of the way, let's get into our topic for today. A liquidity pool allows crypto traders and investors to gain market liquidity in the decentralized finance markets. More specifically, liquidity pools are a pool of funds placed into a smart contract to provide liquidity for decentralized exchanges, also known as DEX, lending and borrowing protocols, and other DeFi applications. You can think of a liquidity pool as a decentralized alternative to an order book or matching engine powered by smart contracts. Crypto liquidity pools play an important role in the decentralized finance ecosystem, in particular when it comes to decentralized exchanges. Liquidity pools are a mechanism by which users can pool their assets in a DEX's smart contracts to provide asset liquidity for traders to swap between currencies. Liquidity pools provide much-needed liquidity, speed, and convenience to the DeFi ecosystem. Before automated market makers came into play, crypto market liquidity was a challenge for DEXs on Ethereum. At that time, DEXs were a new technology with a complicated interface, and the numbers of buyers and sellers was small, so it was challenging to find enough people willing to trade regularly. AMMs fixed this problem of limited liquidity by creating liquidity pools and offering liquidity providers the incentive to supply these pools with assets, all without the need for third-party mediators. The more investments in a pool and the more liquidity the pool has, the easier trading becomes on decentralized exchanges. When liquidity providers deposit funds in a pool, they receive a liquidity provider token, also known as LPT, representing their pool share. Liquidity provider tokens are used to determine the amount of funds LPs contribute to a pool and the allocation of transaction fees they receive for providing liquidity. This enables LPs to have control over their assets while they are in the pool. Considering LPTs have the same properties as other tokens of the blockchain they run on, they can be staked, traded, or transferred to different protocols of the identical blockchain. For example, a BNB BUSD LPT can be staked on PancakeSwap to earn the trading platform's protocol token, Cake. I know what you're thinking. Why are liquidity pools so important? Any seasoned trader in traditional or crypto markets can tell you about the potential downsides of entering a market with little liquidity. Whether it's a low-cap cryptocurrency or penny stock, slippage will be a concern when trying to enter or exit any trade. Slippage is the difference between the expected price of a trade and the price it is executed. This market order price used in times of high volatility or low volume in a traditional order book model is determined by the bid-ask spread of the order book for a given trading pair. Slippage is most common during periods of higher volatility. It can also occur when a large order is executed, but there is not enough volume at the selected price to maintain the bid-ask spread. This means it's the middle point between what sellers are willing to sell the asset for and the price at which buyers are ready to purchase it. Liquidity pools aim to solve the problem of illiquid markets by incentivizing users themselves to provide crypto liquidity for a share of trading fees. Trading with liquidity pool protocols like Bancor or Uniswap requires no buyer and seller matching. This means users can simply exchange their tokens and assets using liquidity provided by users and transacted through smart contracts. Uniswap is the world's top decentralized exchange. It runs on the Ethereum blockchain and uses groundbreaking automated market maker technology to execute trades. In 2020, Uniswap infamously flipped Coinbase's total trade volume. The event marked a watershed moment in the evolution of DEX technology from novelty to the future of finance. Trading on Uniswap doesn't require counterparties like buyers and sellers. Instead, you trade assets with the Uniswap liquidity pools using the exchange's swap interface. Anyone can provide liquidity to the pools, and anyone can trade with them. This basic yet elegant exchange format has proven so popular that Uniswap's structure gets cloned nearly daily. Suppose a pool that started with 1 ETH and 2,000 DAI. If you wanted to buy 0.5 ETH, the trade would throw the price of ETH and DAI wildly out with the larger market. It would be so severe that it's unlikely that anyone would ever make such a large trade. So if no one is ever willing to make trades that use most of the liquidity on one side of any pool, that also means that no one would ever buy nearly as much ETH as sits in the whole pool or almost as much DAI. Only a portion of it is ever likely to be traded, and so there is wasted liquidity. Uniswap's next version will create a different system, one in which a liquidity provider can define a range of the AMM curve at which they will participate. If the price falls outside of that range, their liquidity just sits it out. That might sound like wasted liquidity, but people will load up in the part of the curve where trades are most likely. So it actually means there will be a lot more liquidity. That has the impact of allowing traders to make much larger trades within the normal expected range of a given pair. Stablecoins provide the most straightforward example of why this is powerful. 1 USDC should generally trade for 1 DAI because both are closer to the dollar. Yet, in simple AMM, a big trade can knock the prices for the two widely off the mark. With Uniswap version 3.0, though, a trader will be able to define their liquidity as only participating in trades where DAI sells for no more than $1 and no less than 99 cents USDC. If they put in $1 million of liquidity with that parameter, a trader could be guaranteed a trade of, say, $500,000, with slippage no greater than a penny. PancakeSwap is a massive decentralized exchange and yield farming platform on Binance Smart Chain. You might be thinking, if Uniswap already exists, why use PancakeSwap? There are several reasons, but the best have to do with trading fees, yield farming, and transaction speed. For starters, PancakeSwap trades tokens using the BEP20 Binance token standard. So if you intend to trade Ethereum tokens on PancakeSwap, you need to use the Binance bridge to change your ERC20 tokens into BET20 equivalents. Once done, you're inside the BSC ecosystem and can enjoy the low fees afforded by the network's high throughput capabilities. If it seems like a hassle converting your tokens just to use PancakeSwap, consider the insane amount of yield farming opportunities the exchange offers. PancakeSwap farms and Sierra pools feature 200% plus yields paid in the exchange's native Cake token. On top of yields from farming, staking your Cake tokens entitles you to revenue share collected from trading fees. The huge DeFi yields plus the revenue sharing feature of the Cake token explain why PancakeSwap has its total value locked into its platform than Uniswap. Right now, PancakeSwap has $7.4 billion locked across its liquidity pools and farms. In the early phases of DeFi, DEX suffered from crypto market liquidity problems when attempting to model the traditional market makers. Liquidity pools helped address this problem by incentivizing users to provide liquidity instead of having a seller and buyer match in an order book. This provided a powerful decentralized solution to liquidity in DeFi and was instrumental in unlocking the growth of the DeFi sector. Liquidity pools are one of the core technologies behind the current DeFi technology stack. They enable decentralized trading, lending, yield generation, and much more. These smart contracts power almost every part of DeFi, and they will most likely continue to do so. Well, guys, that's all we have for you today. What are your thoughts on liquidity pools in cryptocurrency? Let us know in the comment section down below. If you guys like this video, then be sure to give this video a big thumbs up. Also, if you don't want to miss out on any new future videos, then be sure to click on the subscribe button and turn on the notification under this video so that you're notified the next time we upload a video on the latest cryptocurrency news. Thanks for watching. We hope you have a great day today, and as always, we'll see you in the next video.